You know that feeling, right? You check your phone, see the headlines screaming about a market drop, and you get that awful knot in your stomach, that panic.
Oh yeah, that fight or flight thing kicks in immediately.
And the instinct is just sell. Sell everything. Run for the hills before it all vanishes.
Completely understandable. But honestly, that reaction, that's actually the biggest threat to your long-term financial health. The fear itself causes way more damage than the drop usually.
And that is exactly what we're diving into today. We're pulling out the key ideas from the Unshakeable, your Financial Freedom Playbook.
Mm-hmm.
And look, this isn't really about getting rich quick. It's more a guide, maybe, to moving past that fear, to getting like genuine financial peace of mind, no matter what the market's doing.
Yeah, our goal here is to help you see how to separate that gut emotional reaction from, well, from a proven strategy. We're going to look at the mindset piece, the psychology, and then distill those core 4 rules that, the really successful long-term investors use.
Okay, let's get into it. Part 1, and this feels like the hardest bit, honestly, mastering your own mind. The playbook is super clear on this. The biggest risk to your money isn't a crash.
No, it's the person, staring at the screen. It's us. The typical cycle is fear-driven, right? You panic when things look bad. You sell low, locking in those losses.
Right.
Then, only when things feel safe again, when the recovery's already happened, you feel okay buying back in. Investing is like 80% psychology.
But, okay, saying don't panic is easy when everything's going up. How does this playbook actually help you separate the facts from that sheer terror when, say, your portfolio is down 25%?
Well, it really forces you to look at the hard facts, the history. Fact is, market corrections, that's like a 10% drop or more, they are completely normal. Expected, even. On average, they happen about once a year. So, yeah, pretty normal.
Okay. And what about the really big ones, the bear markets?
Those are also inevitable, unfortunately. Just less frequent. A bear market, that's a 20% drop or more. But here's the key thing, the really powerful truth you have to hang on to. Every single bear market in U.S. history has been followed by a bull market. Every single one.
Without exception.
Without exception. The market always recovers.
Yeah.
Always. And it eventually goes on to set new highs.
So the loss is only temporary unless you panic and sell near the bottom. Then you make it permanent, and you miss the recovery.
Exactly right. That's why the playbook uses that great analogy, the fire sale.
Right, I remember that.
Yeah. If really good assets, like solid companies, suddenly go on sale, maybe 30% off, you shouldn't feel fear. You should feel, well, maybe a little excitement. It's an opportunity to buy quality at a discount, not some catastrophe you need to escape.
That's a huge mental shift, isn't it? Viewing volatility as opportunity. So the main takeaway on mindset is, except corrections are just seasons. They come, they go, they're not the end.
If you could really internalize that, you've built the psychological foundation you need. You're halfway there.
Okay, foundation built, hopefully. So we've accepted the storm will pass. Now we need the actual plan, the tactics for navigating it. What's the very first principle from this playbook?
It sounds almost too simple, but it's number 1 for a reason. Principle 1 is don't lose money.
Wait, don't lose money, but the goal is growth, right?
Yeah.
Getting wealthy isn't being purely defensive, kind of counterproductive.
You'd think so, but no.
Yeah.
Not really. See, long-term wealth comes from compounding. Your money making money.
Right.
But if you take a massive hit, say you lose 50% of your capital, you don't just need a 50% gain to get back to where you started. You need a 100% gain.
Wow. Okay. Just to break even.
Just to break even. You kill the compounding effect. So protecting your principal, avoiding those huge losses, that's actually job number 1. It makes the long-term compounding possible.
Okay, got it. Protect the base. That sets the stage for principle 2 then. Because we can't just sit in cash forever. We need growth safely. How do we filter for that?
That's exactly where principle 2 comes in. Asymmetrical risk reward. This is the filter for making smarter bets.
Asymmetrical risk reward. What does that mean in practice?
It basically means you're looking for investments where the potential upside, the potential gain, is way, way bigger than the potential downside, the risk.
Okay.
The specific target they suggest is aiming to risk, say, $1 for the realistic potential to make $5. Or more, ideally.
Okay, so a 1-to-5 ratio minimum.
Right. That kind of discipline automatically pushes you away from, those really speculative gambles where you could lose everything for maybe a small gain.
Yeah.
It forces you towards quality, towards things with real long-term value.
That makes sense. A powerful filter. Now, something I think a lot of people, myself included, maybe overlooked. Principle 3, fees and taxes.
Oh, this one is huge. Absolutely vital. Because look, it's not just about how much your investments make, it's about how much you actually get to keep.
Yeah.
And the book uses this perfect analogy. It calls fees and taxes termites, silently just eating away at your returns over time.
Termites. That sounds bad. But, like, how bad is it really? Are we talking small nibbles?
It can be way more than nibbles. The numbers are actually pretty
Yeah.
shocking. Take a typical actively managed mutual fund. Maybe it has a 2% management fee. Seems small, right?
Yeah, 2% doesn't sound like a disaster.
But over 30 years, compounded, that 2% fee can literally devour more than half of your potential returns. Half. Gone, just in fees.
More than half. That's, wow. Okay, that's not termites, that's a wrecking ball.
It really is staggering when you see the math.
So what's the antidote? What's the simple fix this strategy recommends to keep the termites out?
Well, the beauty is, it is simple. Low-cost index funds.
Index funds, like
Yeah.
tracking the S&P 500 or something.
Exactly. Instead of paying a team of managers big bucks to try and beat the market, which they rarely do consistently, by the way, you just buy a whole market or a big slice of it.
And the fees are lower because...
Because it's passive. There's no big management team making decisions. The fees are incredibly low, like tiny fractions of a percent sometimes. So almost all the return stays in your pocket, compounding for you, not for the fund manager.
Simple and cheap wins again. Okay, that covers fees. Principle 4, the last one, diversification and asset allocation. We hear diversify all the time, but the playbook says it's more than just owning like 20 different tech stocks.
Oh, absolutely. That's not real diversification.
Yeah.
True diversification means owning different types of assets, things that behave differently in different economic climates.
Yeah.
So yes, stocks, but also bonds, maybe some real estate, maybe commodities.
Okay, different categories.
Different categories that don't all go up or down at the same time, ideally. That's how you build resilience.
And the book suggests a specific way to allocate using two distinct buckets.
That's right. A really practical approach. Bucket number 1 is your security bucket.
Security sounds safe.
It is. This is for your safe investments, things like high-quality bonds. Its main job is to protect your principal. Keep that base safe. It's there for peace of mind, and it gives you money you can access, even if the stock market is crashing.
Okay, that's the anchor. What's the second bucket?
Bucket number 2 is your growth bucket. This is where you put the assets that have higher growth potential. So typically, those low-cost stock market index funds we talked about.
Got it.
Its job is long-term wealth building, capturing the market's upside over time.
And the genius of having both is what? It stops you from panicking.
Pretty much. If your growth bucket, your stocks, takes a nosedive, your security bucket is likely stable, maybe even up a bit if interest rates fall. That stability protects you from devastating losses overall.
Right.
And crucially, it gives you the confidence to stay invested, to not sell your growth assets at the worst possible time out of fear. It smooths out the emotional ride.
That makes so much sense. Okay, so we've got the mindset conquer fear and the core 4 strategy, don't lose, seek big upside, kill fees, and use the 2 buckets. Let's connect this all back. What's the ultimate point? The why behind being unshakable?
Yeah, the playbook really hammers this home. Money isn't the end goal. It's just a tool. The real objective isn't just being rich. It's achieving genuine financial freedom.
And what does that freedom look like?
Well, it means getting to a point where you work because you want to, because you enjoy it or want to contribute, not because you absolutely have to grind just to pay the bills.
Yeah, that's the dream for a lot of people.
It gives you choices,
Mhm.
resources for your family, for experiences, for travel, maybe for giving back to causes you care about. It's about having options.
So by controlling your emotions with the right mindset and then applying these actually pretty simple core 4 rules.
You're essentially building a machine, a system that generates wealth more or less automatically over the long haul while you sleep, while you live your life. You go from being afraid of the market, afraid of the future, to actually being kind of excited about the possibilities, living life on your terms.
Okay, let's try and boil this down then. For everyone listening, if you take away just 3 core ideas from this deep dive on being financially unshakable, maybe remember these. 1, mindset. Fear is your real enemy, not the market. Remember, corrections are normal, they're temporary, and honestly, they're opportunities if you're prepared. 2, strategy. Keep it simple. Stick to the core 4. Rule 1, don't lose big. Rule 2, look for that skewed risk reward, that 5-to-1 potential. Rule 3, use low-cost index funds to beat those termite fees. And Rule 4, diversify properly with the security and growth buckets. And 3, the goal, why bother? Freedom, choice, and just, sleeping well at night. Real peace of mind.
Thinking about this approach, which is really grounded in just looking at history and sticking to simple rules, it raises a bigger question, doesn't it, beyond just money?
How so?
Well, if history proves that market storms always pass, that the market always recovers eventually, what other fear, maybe unrelated to investing, is dictating a big decision in your life right now? Could you apply this unshakable mindset, this focus on facts over fear, to other areas too? Build confidence there.
That's actually a really powerful thought to end on. Use this as a template for courage elsewhere. I like that. Okay, a great challenge. Go out there, get your mindset right, stick to a simple, proven plan, and start building that unshakable future.